So let's go on to the opportunities. Again, we talked about the fact that we're going to highlight some of the strategies, a strategy every week. So let's go ahead and look at that. Rocky already told you we're talking about the investment strategy and wealth enhancement. We've got 5 strategies that we're working on and have actively structured for our clients at this time. Today, we're going to look at Roth conversions. So the question, does converting really make sense? And I'm here to prove to you, I believe that it does. There are multiple benefits to a Roth conversion strategy beyond what we're talking about doing during this crisis right now. But let's talk about those real briefly. First of all, if you do a Roth conversion, you really stack the deck in your favor. In other words, hey, if taxes never change, it's no harm, no foul. You did the conversion, it didn't really hurt you from a tax standpoint. However, if taxes do go up, like most of us believe it's going to, then your delta between doing the conversion and not doing the conversion, it just, the window gets bigger and bigger on your favor. So stacking the deck makes a whole lot of sense. It's one of those things, better to be prepared for an opportunity and not have it come than have the opportunity come and not be prepared, right? Well, we want to be prepared. The next one is control your tax brackets and you control your income tax. What do we mean by that? Well, if I've got a Roth account and I need income coming in, I can actually regulate the taxable income by bringing in additional income from the Roth if needed. That helps me control the tax bracket. So that keeps my taxes lower. The next one, asset location investing. I'm not talking about asset allocation. We're talking about asset location. And that is where we literally target the rate of return based on the tax status of your account. So if you have an IRA, that's going to be a little bit more conservative. If you have a Roth, that's going to be more aggressive. Again, we want the tax-free money to grow faster. So asset location, studies have been done that says that if you do this properly, you will end up with about a 1% increased net rate of return over time, annualized, for your investment. So that is a huge one, but you can't do it if you don't have a Roth. So it's important to make sure we get that implemented. The next one, who here absolutely wants to be forced to take your required minimum distribution? Well, I know not a lot of clients don't. They don't need it, but they're forced to take it and subsequently get taxed. Well, the less you have in your IRA means the less RMD. So the conversion actually helps you control your taxes there as well. Next one. Now, this is something that nobody seems to talk about, but it is a huge benefit for clients. Everybody talks about fees, but if you don't look at converting money, you're not actually utilizing every method to reduce your fees down. What do I mean by that? Well, if I have $1 million IRA, I know that all of that is not my money. Part of it belongs to Uncle Sam because he hasn't taken his tax out yet. So even if you were at a 20% tax bracket, 20% of that money is being feed by the advisor because the whole account is being feed. Now, I'm not advocating lowering my fees, but it's a byproduct of this strategy for our clients. So when you're looking at it, if you remove Uncle Sam's taxes, you're not trying to grow his money anymore, which also means you're not paying your fee on that money. It reduces the dollar amount that you pay on an annual basis, and that's a good thing as well. So if we go back to this chart and we look at the presentation I'm going to show you on the Roth conversion and how that can benefit you, we already know that they're looking at a 10 to 15% correction in the market. We're going to look at the number 12.5%, as the correction number when we do our calculations here. So let's move on. Here's how the story goes. We've got John here. John has an IRA that grew to $1 million. And this was prior to the crisis. So he's feeling pretty good about things. But then we have the crisis hit us. And, you know, the market drops down. His account goes down to 750. There's a lot of volatility going on. You're starting to see the recovery like we're doing right now. So it goes down 750, then retrace or comes back up to 885. And he's thinking to himself, well, we're going to have a next downturn. So why don't I do a Roth conversion? And in this case, he's going to do that Roth conversion for $100,000. So as we move forward, here's what comes to play. Let's say the market does retrace that 12.5%. Now, John's looking at it and saying, okay, I'm going to convert that 100,000 over to a Roth. Now, I have to make this note. When you convert on a downturn, you're effectively converting a higher percentage of that IRA to a Roth. In other words, if you've got $1 million and you convert 100,000, you're going to convert 10% of that account. But if the market drops down to the 769 mark and you convert 100,000, you're actually converting 13% of the money. So it's a much larger percentage, which means you don't have to convert as much down the road. So let's keep moving here. So we do the conversion, the market comes back to even, which by the way, would probably take about a 30% return back to get us back to normal. So all the accounts at that point have moved forward getting a return. So your IRA went up 30% and so did your Roth IRA. So your Roth was 100,000, now it's 130. So that's important. Why is it important? Well, let's look at the numbers. When you think about it, all the money eventually is going to be taxed. Now, I'm giving you some relatively conservative tax numbers here. So in John's case, his federal tax rate is 22%. State tax rate in Michigan is 4.2. So this gives John 26.2% total tax obligation. So what is 26.2% of $1 million? $262,000 in taxes. Again, that's Uncle Sam's money, the 262. So let's compare that to actually doing the conversion of the account, $100,000, and let's see how the numbers play out here. So you still have your IRA, which is still fully taxable, 26.2%, but your Roth account doesn't have a tax on it. So there is no tax obligation on that money or the money that grew in there. So the total tax obligation after the strategy and the market getting back to where it was is $227,940. So just about $228,000. You look at prior to this crisis, and he was paying $262,000 on the $1 million. So that's a pretty good savings of $34,000 in taxes by doing this strategy while the market is down. You know, any time's a good time to do a Roth conversion, but there are opportunities like this that come about that actually enhance that Roth conversion. So good numbers, great strategy. We just got to allow that, or hope the market comes back down again to get that execution point. And we will keep you apprised of what's going on relative to that as the market moves forward. So that kind of brings us to what are the current updates on the strategies we're already trying to implement. Well, you know, while the market was up, we're paying the taxes on the pre-crisis Roth conversions, and also we've been paying any kind of life premiums that were due that we did not pay during this crisis when the market was down. So that's all being implemented. If you were in that window where we were working on those, you probably got an email or a phone call from our office. If you haven't gotten that yet, you will as we execute these programs.